Hello everyone, this is Abhay Agarwal from Piper Serica, taking this opportunity to review our portfolio performance for the month of November 2025, and also talk a little about the market outlook as well as the changes that we are making in the portfolio. So first of all, I think the markets in India hit a new high last month, which happened after a 14-month period of consolidation. Now, at the same time, there is a marked difference in performance of the large caps and the small and mid caps. So if you see in last 1 year, the Nifty index, which is the benchmark index, is up 7.8%, whereas the small cap index is down 4.4%. So there is almost 12%, more than 12% of underperformance by the small cap index. And because of our portfolio constitution, which is about 60% small cap, 20% mid cap, and 20% large cap, we are somewhere in the middle of this range. So overall, we are tracking our long-term returns well, which is 19.3% over 5-year cycles. And we are very hopeful that we will continue to maintain it or better it. But at the same time, the short-term correction has led to some interesting opportunities for long-term investors. What we have seen is that the valuation premium of the small cap index, which was at 58%, has now corrected to about 30%, which is a lower level of the average range that typically the small caps in India have traded when compared to the large caps. And that premium kind of justifies the faster growth rate of the small caps and mid caps. So we expect the mean reversion to take place, and this underperformance of small caps compared to their large cap peers, which happens every 5 years roughly, we have seen, would catch up over the next 3 or 4 months. At the same time, while this catch up takes place, because of the correction in valuation of high growth companies, we are seeing interesting opportunities where we are able to invest in some of these companies that are targeting a growth rate of 25 to 30% year on year for the next 3 to 5 years at a PEG ratio of about 1.5 to 1.7, which we believe is a very attractive zone to get into these companies, because these companies will turn out to be the multi-baggers over the next 3 to 5 years. So we are using this opportunity. That's the portfolio strategy. Recently, you would have seen we have added companies like Senoris Pharma, Car Trade, and more recently, Inox India, which makes cryogenic tanks, which is a very specialized technical business. And we have on our tracker a couple of other companies. So what we are going to do is to replace from the portfolio companies that we believe are on a slow growth path, and their valuations may be optically low at a P multiple level, but at the same time, when you build in the growth, their valuation is actually higher than some of these faster growing companies. So we are going to churn out of these companies and use that cash to deploy in the faster growth companies. Where we are seeing opportunities in India very clearly is the banking and financial services space. We believe that a cyclical bottom is largely in place as far as credit cycle is concerned. A lot of over leveraged by unsecured borrowers has already been cleaned up. And now we are looking at a situation where a credit offtake of good quality and at the same time better lending practices are kicking in place. And some of these smaller banks and NBFCs, which because of cyclical downturn saw their valuation multiples fall below one-time book value, we believe are an attractive opportunity with a 1 to 2 year perspective. Second space that we see obviously is EMS, where we're seeing our companies like Amber, Sirma, Keynes go from strength to strength. So that is an area that we are actively evaluating for more additions if available. The third space is pharma. We believe that contract development, contract manufacturing, contract research, this will be big business in India. Right now, people are focused on the generic manufacturing in India, but the version 2 or phase 2 of pharma business in India will be driven by these companies that are focusing more on the contract business that comes their way from large international players. And that is a very remunerative business, and it's a very sticky business. So we believe that some of the companies which are small cap right now will emerge as mid and large caps over the next 3-4 years from this space also. Other than that, we are seeing attractive opportunities in consumer internet space in India. Valuations are expensive, so while the companies may be interesting, the valuations are expensive, so we are not biting the bullet yet. We will see how the valuations adjust downwards. And also, we are looking at some of the companies that have come up with their IPO recently. A lot of them are trading at high multiples right now because of the newness. But typically, we have seen that the market's bluster wears off over the next 12 months. So we are keeping them on our track. We believe that some of these companies are very high quality companies, but we will buy them when the valuation is something that we are more comfortable with. So we will wait for that time. Overall, the big point is that there is no dearth of opportunities in India for a growth investor. We believe that multi-bagger returns will come to those who are patient and who at the same time use these periods of correction and underperformance to boost their portfolio with growth stocks, which is exactly what we are doing right now. So you will hear more from us in the next update. We will be happy to share more names with you at that point of time. On the market side globally, I think there is this AI bubble that people talk about, but I think it's not just AI bubble. I think it's a large tech bubble which has kind of outlived its time right now. The US market has a $65 trillion market cap roughly, and a very large part of that is cornered right now by the big tech 7 stocks, as we call them. Nvidia with a $5 trillion market cap, and then you have two companies which are $4 trillion market cap, I think Google, Microsoft, and then you have others like Tesla and the likes, which are taking a very large share of the flows into the US markets. I don't think this is a situation which is sustainable. This has also led to a weird situation where the share of US markets in the global MSCI index has gone up to 72% from the normal 65%, which was the case about a year ago. What that means is that a very large part of global equity flows are going to the US, and most of them are going into these tech stocks. And it's not that the rest of the broader US market is performing. In fact, there is a remarkable underperformance there also between the small and mid caps and traditional companies compared to the large cap US stocks. So I think this situation will break, or there will be some correction at some point of time, which will be good news for flows into the emerging markets. The share of emerging markets in MSCI Global Index is at its probably 5 or 6 year low. And we have seen that a reversal comes and then this increases. India's share of the global flows is about 2%. We believe that this can go up to 3%, which will further, help the market get back to its normal level. So as far as the Indian market is concerned, we have no short-term or medium-term worries on the horizon. The macros continue to be in good shape. The consumption-driven growth is picking up. We can see it in terms of our dealer checks and what is happening on ground. I think what the government has done in terms of boosting consumption-led growth is working. There are worries on the sudden correction in rupee against the US dollar. So we have seen rupee go from 87 levels to 90 right now. But overall, if you look back over 20 years, rupee has depreciated about 3.5% per year against the US dollar. So I think we are broadly in that range. RBI manages that range pretty well. There is nothing to say right now that rupee will go for a further big crack. I think up to 90 is the range that RBI is comfortable with. So I think the rupee will stay around this level. We have seen that when a sharp correction takes place and the rupee stabilizes, we get a lot of FPI flows after that. So I think that is what we are probably prepping up for. So I would like to once again summarize this before I sign off by saying that the short-term underperformance will lead to medium to long-term outperformance. We are very confident that the companies we are investing in have a very predictable growth path and will reward the shareholders by creating more and more shareholder value. We have more opportunities that we are considering right now. and you will see them being added to your portfolio over the next 3 to 4 months. So thank you very much for your time, and looking forward to coming up with the next update over the next 1 month. Thank you.